Speaker's Corner aboard the Villa Vie Odyssey, hosted by Kit Cassingham.
Wow, there's a lot of people in here tonight. Cool.
We're all interested in money.
Well, I'm Kit You have to talk to the speaker. I'm Kit Cassingham, and this is Speaker's Corner. Welcome. Are you interested in learning the language of bond investing? How about how to buy individual bonds? Or bond prices? Bonds and how they're priced? And the risks associated with buying and holding bonds. That interest you? You're in the wrong room. Well, Michael is going to talk about all of that and a little bit more. So sit back, listen as Michael Cooke talks to us about Bond Investing 101 and a little bit more.
And a little bit more.
Come on up, Michael.
Thank you. Thank you. Appreciate it.
Welcome to the Odyssey.
Oh, well, thank you. It's so fun. So nice to be here. So nice to be here. I want to thank you all for coming. Couple of disclosures. Somebody from home reminded me that I need to have this disclosure. She called it the CYA thing. But basically, it's a saying that I'm not a financial advisor. I'm not an investment advisor. I don't even play one on TV. And if I were going to play something on TV, it certainly wouldn't be that. I'd probably be a doctor or a sportscaster or something, chick magnet kind of thing. But that's not what we're here for. So what I want to do is I'm going to go and we're going to talk about jargon. Everybody has a handout. And you need to have, it's impossible to talk about it if you don't know the language. So we're going to go over that. The other thing is I'm going to try to avoid math because math is boring, but there is one slide, and I will refer to it a couple times, about how you do some of the stuff in math. The cool thing is we have this thing called the internet, and you can go and you can find calculators for virtually any of the calculations that would be included or interesting as part of the presentation. So hold on, I'm going to try to make it as exciting as it possibly can be to talk about bond investing. Okay, so investing in bonds. Why? You might give a ship and my credentials. So, and I'm not going to read this, but basically you probably have, if you're, most of everybody here is retirement age, you probably have a, IRA account, 401k or whatever it is. So you've got some money in a retirement account, you probably have money in non-retirement accounts, and you're diversified, so you probably have invested in bonds. So you kind of might give a ship as to what you really are invested in. That's the way I look at it. The second thing is, what are my credentials? Well, I'm interested in investing. I've always been interested in this. I talked my dad into buying some stocks when I was 9 years old. He bought me one share of Chris Craft, and it went from 14 to 40 and then went back down to 14 or something like that. And I thought they made model airplanes. Turns out they made really cool boats. And then the other thing is I have read this book called The Bond Book by Annette Thau, and I read version 1 because that was the one at the library, and then I bought the second edition. It is a tome. If you can't sleep, get the book. But it is very, very interesting. About 18 chapters. We will be talking about hardly any of those. So anyhow, we're going to go over the jargon. I have a handout. I encourage you to take notes. And the reason I wanted to have you actually jot some stuff down is it helps it stick in your head a little bit and then a little bit longer. So everybody have a handout? Yay! Okay, if you don't, sorry. If you don't, well then there'll be a quiz for those who don't have one later, okay. So we're going to talk to some of the things. So we'll go quickly. So there's a thing called par or principal, and that's the face value of a bond, typically $1,000. And it is the principal amount that is returned when the bond comes to maturity. We'll go into those. So coupon is the rate of interest that's paid to the bondholder as listed on the offering. It's shown as a percent, so it might have a coupon rate of 3%, 4%, 5%, or whatever. The interest rate is not the coupon rate, but it's the actual rate of interest gained when purchasing a bond, and the purchase price might be different, more or less than par. Maturity is the date when the bond seller makes the final coupon payment and returns the principal to the bondholder. We're going to be talking mostly about corporate bonds, a little bit about treasuries and munis. If you have some more questions about that, we can get to that later. And then we're also I just want you to think about a thing called the risk-free rate, and that's the current rate of U.S. Treasury debt for a specific maturity level. So there's like a 5-year risk-free rate, 2-year risk-free rate, and that's my terminology. But the reason those debt instruments are considered risk-free is because the U.S. government has always made interest payments and has always paid back the principal. So, yay. The other one is the concepts in bond investing. So we're going to talk a little bit about present value and future value, or the time value of money. Everybody do you understand time value of money? Maybe not. Okay, good. I saw some people shaking their heads. We'll go through it. So the concept there is the time value of money. What is the present value of, say, $2,000 that you have on June 1st, 2023, and it's based on a discount rate, which would be like the current risk-free rate, perhaps. But think about, you won the lottery for, $400 million, and you go, I don't want to take the payments because nobody does. But you say, well, I want the lump sum. So that would be the present value would be the $140 million that you got instead of the $400 million, because that's, if you took that money, put it in the risk-free rate, and waited 30 years, you'd end up with $400 million. So that's one way to think about the time value of money. We're going to use the term income stream, and that's a regular stream of income payments for, like, think Social Security, or if you have a pension. Also the periodic payments from a bond. We're going to, and then they have, I think there was the bond rating system, Moody's and Standard & Poor's. These companies conduct an analysis of the issuing company and then value the creditworthiness of the issuer. So they use alpha characters in the ratings. AAA is best. D is basically mean that the bonds are in default. Then we'll talk about investment grade and junk bonds, so there'll be more information on that. New issues in secondary bond market. So bonds are issued sort of like IPOs in a way. A company will say, we need another $150 million in cash, so we're going to go sell some bonds, and then they do what they call an offering. So that's what the offering would be. Once the bonds they come up with a date, they have a lot of information in that particular offering, the purpose of it, how much the bonds are for or worth, and the payback periods and all that stuff. After a bond has been issued, it can be traded on what they call the secondary market. That would be sort of like how stocks are traded all the time. So you can buy shares of Apple or Intel or whatever it is on basically the secondary market. There is a secondary market for bonds as well. And then what I call the bid and ask pricing. It's the spread. And so bonds, not unlike stocks, are sold at an auction. And so there was what they call a bid and an ask. So whoever owns the bonds will say, this is how much I want to get for this particular bond over a particular maturity and a particular creditworthiness. And there are people who say, I'm willing to buy that bond, here's how much I'll bid on it. And when you get a combination where the bid and the ask are the same, there's a transaction and the bond is sold. Unlike stocks, bonds trade pretty thinly. There's a lot of bonds. The bond market is, I think, 3 times as much as the stock market as far as the total value, but a lot of bonds are traded very thinly. So I was looking the other day at Microsoft, and I think 140 million shares traded in one day, and I bought bonds where there were maybe 100 bonds traded in one day, if they were traded at all. So it's a totally different market. And then we'll talk about investment grade and stuff a little bit later. Okay, so what is a bond? Basically, a bond is an IOU issued by a corporation, government agency, government, or whatever. The bottom line is somebody is lending money to somebody else. It's like an IOU. Like, for example, you might want to come up to me and say, hey, can I borrow $100? And I go, sure, we got an IOU, and you'll pay me back in a couple of weeks or a couple of months. So we've gone through all this. Again, you have the handouts. So typically, new issue bonds are sold at par, which is at $1,000 per, and one bond is $1,000, and that's the coupon rate. Bonds will pay interest at a rate that may or may not be the same as the coupon, depending on the current market. So for example, about 3 weeks ago, I bought a new issue bond. The coupon was 5.2%. That's a little bit higher than the actual market rate for that particular bond, so I paid a little over par for that one. Bonds will pay interest at the coupon rate, regardless of what the interest rate is, until the bond matures, at which point the bondholder will, or the seller, the company will pay back the interest on the final coupon and then go ahead and pay back the principal. And we talked about those. So here's an example of a new issue bond. Apple Corporation issues a bond at par on February 1st of 2026, a few days from today, and it's got a coupon of 5%. It'll pay interest on August 1st, that's the next 6 months, because bond pay interest every 6 months, and we'll continue to do it every 6 months. So it'll be August 1st, February 1st, August 1st, February 1st, until February 1st, 2035 in this example, and then everything will be paid back on the February 1st. So we have a concept where you get, the bond will be issued, it'll have a maturity date, it'll have a coupon date, and new issues almost always trade at par. So you know exactly $1,000 in, $1,000 out. Quick question, but if we can hold the questions in the future till the end, but go ahead.
You never said it, you maybe 5%, that's an annual rate.
Say again?
The 5% is an annual rate?
Yes, that's the annual rate, yeah, that's the annual rate, right. All these will be annual rates, yeah. So here's a secondary market bond example. So AT&T issued bonds sometime in the past with a maturity of December 1st, 2030 and a coupon of 4%. The current rate is now 5% in this example for the same maturity level and credit worthiness. And so that bond would sell at a discount to par with an effective interest rate of 5%. So there would be a discount there of about $965 instead of $1,000. And one of the things I want to also mention here is, so whenever a bond is issued, it has a specific maturity level. So let's say a 10-year bond in one example, or a 5-year bond, or whatever. But as the bond gets closer and closer to maturity, it trades like say in the example, a bond that had 5 years left, even though it was a 10-year bond, it trades like a 5-year bond. And when it only has 3 years left, it trades like a 3-year bond. So even though it may have been originally issued at a 10-year maturity, it will trade as the same level of other bonds of the same maturity level. So the time between when you buy it and when it's going to go ahead and mature. How to calculate the bond price. This is the math. You're more than welcome to get out your Excel files later on and do this. There's a couple of things that are interesting here, because the bond price is equal to the sum of basically the coupon payments. And that's an interesting factor, because that is more important for the pricing when the maturity is long, and less important when the maturity level is short. So the income stream of a bond of 4 years is going to be relatively short. One of 20 years is going to be much longer. And so that plays a bigger factor in the price of the bonds. One of the things when you're pricing bonds is that, and we'll get into that when we talk about risk, but is being able to reinvest, how you're going to reinvest the coupon payments. So the bond rules to know. The yield of the bond increases, the price goes down. The price of the bond, the yield of the bond decreases, the price goes up. And this is the inverse rule for bonds. It is the inverse rule. Inverse rule, this is one of the takeaways. Please remember the inverse rule. Prices go up, yields go down. Prices go down, yields go up. It's kind of counterintuitive. And one of the things I have stuff on my phone. I keep track of my bond ETFs, and I notice that when the price goes up, I know yields have gone down. When the prices go down, I know yields have gone up. And that's based on the math. We're going to talk a little bit about risk. So there's interest rate risk, reinvestment risk, and default risk. So interest rate risk is the risk that you bought a bond and you had a coupon. When you bought it, the effective rate was, say, 5%. And that seemed pretty good at the time you did that. I'm getting 5%, you know. I was getting 3.5 in my money market account. I took 10 grand out on a 5% bond. Things are looking good. Then 2 months later, you could have bought basically the same thing, and it's paying 5.25%. So that's a risk that you have, because interest rates are flexible. They may go up and they may go down. So you have the interest rate risk of the fact that the yields on the bonds could go up over time. It's hard to know exactly what's going to happen, when's it going to happen, but you can kind of be a good judge. On the other hand, when you're buying a bond, you should just pretty much be satisfied with the rate that you got when you bought it. And that's kind of how that works. Reinvestment risk is the risk that the interest rates will decrease before the bond matures. And that goes back to that concept of being able to reinvest the coupon. So the idea in that calculation is that you're going to get your $25 every 6 months or $50 every 6 months or whatever it is every 6 months, and you'll be able to reinvest that money at the coupon or at the interest rate you got. Most people, I don't know what everybody does with their bond interest. I just kind of sock it away in my money market account and buy some more stuff later on perhaps, or use it for buying more fun stuff while I'm sailing around the world on the Odyssey. But that is a risk. So that is what they call a reinvestment risk. There's really not a whole lot you can do about it. You just have to be mindful when you're buying a bond that you may or may not be able to reinvest it. And that's part of that calculation used for pricing. But again, calculators do all the heavy lifting for you. And then there's the default risk. This is the risk that the bond issuer will not be able to perform. They're not going to pay you the money every 6 months or something like that, or for whatever reason, they won't be able to pay the principal. They've gone out of business or whatever. Typically that doesn't happen, and it's really hard to judge the future. But for example, I use this example. So Kodak makes, back in the day made film. They were really good at making film and stuff like that, cameras for film and all that stuff. And you could have bought a 10-year bond from Kodak, and then 2.5 years later, digital cameras come out. And so their future may not look as bright as it had before. Now, did they go out of business? No, they did not. But there is some uncertainty even in brand names that we know and love that have been around for years and years and years. So there is a risk of default even though the company seems super strong, super well capitalized and all that stuff. So be mindful of the risk. So let's buy a bond. Okay, who's ready? Okay, so setting parameters that work for you. We're going to talk about that time to maturity, the credit quality, coupon, and discounted premium. And again, this is very personal. I think that when you're buying a bond, when you have a strategy, I'll talk a little bit about that as we go through, but how you want to think about buying a bond and why you're buying the bond and all that. So time to maturity. Risk is based on time. So the shorter the maturity, a 2-year bond has less risk than a bond that will be maybe 15, 20, 25 years. And the reason is basically a 2-year horizon means that you have less time for something to go wrong. It's just, that's the way I look at it. There's just less time for something to go wrong with that company. For them to lose the ability to pay the coupon or to pay the principal over longer periods of time, 10 years, 15 years, 20 years, as the world changes, their ability to make those payments might diminish. I'm not saying it will, but there's that possibility, that probability that over time, bad things can happen. Like for example, Kit came up to me and she may say, I want to borrow some money and I'll pay you back in 2 years. And I'll probably go, not a problem. But if she says it's going to be 20 years, I may reconsider that because I just don't know what's going to happen to her in 20 years. So we have to be mindful of how that maturity risk is involved. And then how does it and then in case, so you're getting a higher coupon or a higher interest rate on longer bonds because you're accepting more risk. Whenever you accept more risk in any investment, you should be rewarded by getting a higher return. Shorter term bonds are going to pay lower interest when you buy them, or lower coupons when you buy them on issue. And then how does the maturity fit your level? So some people buy bonds just like they put money in a savings account or whatever because they're going to save up, and then 5 years they're buying that Maserati they always had to have. And it may be just a little matchbook one, I don't know, but it might be the full-size one. I'm not going to buy one because it won't fit in my garage, and I don't want to pay that much in insurance. But it's a way to set a goal. So you say 5 years, 10 years, 20 years, whatever, having a goal for why you want to buy a particular bond and what you're going to do with the income stream and what you're going to do with the principal later on is important. So what fits, And then some of us are a little bit older than others, and so maybe a 20-year bond might not be the best idea. It's kind of interesting because, well, how long are you going to live? I don't know. Fidelity says I'm going to die when I'm 93, so I just go with that. Credit quality. So rating companies are a good source, and I don't know if it came in a handout, but if not, I have some. We can get copies out there. But there are two companies that rate other companies to find out if they're creditworthy. That's Moody's and Standard & Poor's. Actually, Fitch is another one, but they're not used that much. And so they go from AAA to I think B plus or BAA or something like that. I have a list and I can get that to you. So investment grade bonds are bonds that the rating companies believe are pretty solid and will definitely be able to make those coupon payments every 6 months, and will be able to return the principal on maturity. But there's AAA bonds and then there's BB bonds. So there is a gradient for investment grades. This is kind of important when you're looking at mutual funds or ETFs, because they will say that they only invest in investment grade bonds, and I own some funds that do that, but I've also noticed that they usually tend to go to the lower of the investment grade bonds because they get a higher interest rate on those bonds. More risk, but a higher return. So if you're thinking about buying junk bonds, don't buy junk bonds, don't buy junk bonds, don't buy junk bonds. It's a lot of work. If you want to buy junk bonds and just go into a fund, those guys are really smart, way smarter than me, probably way smarter than a bunch of you as far as figuring out which companies' junk bonds might be a good investment. Those are bonds that are potentially not paying the coupon rate and they're not in default, but they're shaky. And so a little bit of economic downturn in their particular industry could result in them going into default. On the other hand, the amount of interest you get is much higher. So again, you're making a trade-off, risk, reward. But really, don't buy junk bonds. So the coupon is a major factor in pricing the bond. So if you get a coupon, let's see if the current market is around 5%, and the new issuing company or or even on the secondary market, the coupon is higher than that, it's maybe 6 or 7%, you're going to buy that bond at a premium because you're getting more than the market rate. And if it's going to be much lower, like it's a 5% world and you get 3.5 on your coupon, then you're going to pay less to make up for the difference. So that's the difference between if you're paying over par, you're buying at a premium. If you're paying below par, you're getting it at a discount. On the other hand, you're still going to get your $1,000 either way. So if you bought it at $98 or $980 for a 1,000 face bond, you'll get 1,000 later. If you paid $104 or $1,040, you're still just going to get the $1,000 at the end. Let's see, make sure I didn't skip one. Yeah, okay. So what I like to do is I like to buy bonds with a coupon close to the market interest. I like to pay par. That's just what I thought makes it easy for me. I don't have to worry about making a lot of money at the end or paying a premium at the beginning. I always buy investment grade quality, and I'm looking at 3 to 5 year maturity. The reason I do all those things is I want to get my coupon payments. That's why I'm doing this, and I really am basically taking money out of my money market account that's now getting 3.5% roughly, and I can go buy bonds and I'm getting pretty close to 5%, and that seems like a pretty good deal to me. So that's why I do that. But the maturity level also helps mitigate risk. 3 years, 5 years. For me, because I'm not an investment guru, I rely a lot on the S&P reports and other stuff that I can do to do the research. So I'm going to sit there and spend hours researching every bond that I go ahead and buy. But feel free. So the QSIP is the way that bonds are identified when you're going. And now I'm presuming that you're sitting in front of your laptop or whatever, and you're getting ready to buy a bond, and you're looking at everything, and you see all these crazy numbers, and like, what is that? Well, that is the QSIP, and it's a 9-digit number, basically, or string of characters, 9 alpha. There's alphanumeric characters. And that's how bonds are identified. If you want to go online and look up QSIP, there's a lot more information. Stocks are also done by QSIP. That's just how they do everything. And then if you call me a broker or say I want to buy some Microsoft bonds, that's not going to help because they're going to go, which ones? Because Microsoft probably has hundreds of millions of dollars in bonds outstanding, or other companies will as well. That's the next slide. You need to go buy your bonds through a brokerage company. Each firm have its own list. I use Fidelity. I like their website. I can go in and get a list of all kinds of bonds based on the credit worthiness, whether I want to buy corporates. So if I click on it's got a little matrix, and I'll say corporate bonds with a maturity of 3 to 5 years. I punch that button, it gives a list of all the bonds that are available, all the coupons, the maturity, and all that stuff. But each company has their own way of doing this. I also use Merrill Lynch a little bit. I don't think their system is nearly as robust, but I do that occasionally. And then the price that you offer depends on the broker. So we talked about that bid-ask thing, you know, where there's people who want to sell them and they say, I want this much money, and there's me trying to buy it, and I say, I don't want to pay you that much. On the Fidelity side, you can put in what they call a limit order. In other words, the current ask might be 99.4, and I go, well, I'll give you 99.35 because somebody did that 2 days ago, and I think I can still get that. I might not get it at all. The order is a one-day order, and if it doesn't get placed, then I'm out of luck. I have FOMO and have to worry about that later. But again, this is stuff that your own brokerage firm, whether it's Schwab or whomever, should be able to have a site where you can go ahead, look at the bonds, and buy them that way. So fees and accrued interest are included whenever you buy an individual bond, or actually when your ETF does it. So in one of the examples, I think the bond was going to start on February 1st, and then it would accrue interest till they would make the payment in August. So when you buy a bond, typically you will not be buying it right on the coupon date, the date that the company is going to pay it. So all that interest has been accruing. And if I own the bond and I'm going to sell it to you, I want the interest that has been accrued. So you will end up paying for that, and you'll also pay usually a pretty small fee, about 1/10 of 1%, or maybe a little less than that, depending on the brokerage firm that you work with. In other words, if you were going to buy $10,000 worth of bonds, you're going to pay a little bit of a fee and probably some amount of accrued interest. Could be $50, could be $250, just depends on which one. It's fair. They've already accrued the interest, they were holding it, and then you'll get it. You'll get the payment when the coupon comes due. So what are the advantages of buying individual bonds? We've gone all this work, we know the jargon, and we understand the risks, or we've accepted the risks that we understand, and now why are you going to buy individual bonds? Well, here's the thing. You're going to know exactly what you bought, and you get to decide to hold it to maturity or sell it whenever you want to. The expenses are reasonable. Actually, I was looking at some of the ETFs, and they charge about 17 what I call basis points, or 0.17%, and you can get a buy bond for 1/10, so you can shave a little bit of the cost on there. And you should be able to see recent trades when you're looking at bonds. So when you see a stock commodity, you'll see, if you look at the chart of a stock, even the daily chart, it'll show all the different trades going up and down, and you can get an idea, well, it's trading at around $110 a share, that's a good price, I'll go ahead and buy it at that. You can do the same thing with bonds, but again, the number of trades are much smaller typically, and the volume can be different too. I like this idea. This is what I do. I like the whole buy and hold till maturity. That way I'm locked in. So if I buy a bond, and when I bought it, I knew that the interest rate I was going to get based on the price I paid and the coupon was going to be 5%. I'm locked in. I get 5% no matter what. I bought an investment grade bond. It's going to pay the principal. It's going to pay the coupons, and I know I'm good for 5%. Yay! That's what I wanted. That's what I got. Volatility doesn't matter if you plan to hold a maturity. And the thought on that is, so I went ahead and I bought this bond, and all of a sudden there was a change in interest rates, and the price goes down. It goes down from maybe $1,000 a bond to $940 a bond. I don't care, because I know when it matures, I'm going to get my $1,000. The trading amount doesn't bother me. The volatility doesn't affect me, because again, I'm holding for fairly short maturities, and I'm going to get my $1,000 back, and that's really all I care about. I get my coupon, and I get my money back. So that's one of the reasons that I like this. And also, depending on how much money you want to invest, you can stagger when you get your money. So bonds pay every 6 months, and you can say, well, I want money in January, February, March, and so on. And you can just do that by when you select the bond, you can know when the coupon date is. Or you can not worry about that and just have them all come in January and August. So it's up to you. But that's an opportunity if you want to get a good stream of income through your individual bonds. So what are the advantages of buying bond funds, ETFs, or bond mutual funds? Well, you get professional management at a reasonable cost, and you might get better pricing because they're buying, you know, I'm buying $20,000 in bonds, they're buying maybe $1 million in bonds. They might get a better price because of the volume that they're getting, volume discount kind of thing. They constantly review the portfolio to assess the risk, and if they think that this bond should be sold, they'll go ahead and sell it. If there's some bargains out there, they can go ahead and buy them. And you automatically get diversification in your portfolio, in your bond portfolio, because most bond funds hold hundreds, if not a couple thousand different individual bonds, depending on how much assets they have in their management. Could be, and some of these are pretty big. They're in the, you know, hundreds of millions of dollars, if not more. You can also buy treasuries. We'll talk about treasuries. You can buy treasuries through your broker. That's pretty easy to do, just like you just pick on a little thing that says treasuries and the maturity level, and click on that, and you can see what you want to do there. Or you can also go to this website called treasurydirect.gov, and you just open up an account. You can purchase T-bills, bonds and notes, and you can buy savings bonds and I-bonds through Treasury Direct, although I'm not sure why you would do that. But you could if you wanted to. I think you can, I don't know, can you still buy savings bonds at a bank? That's a good question. I'll have to look that up. I don't think so anymore. So what about CDs? I mean, bonds? I don't want to buy bonds. I just want to invest in CDs. Well, CDs are similar to bonds in many respects. They're issued by banks for the most part. And basically you give them some money, and periodically they have a particular interest rate. They pay you like every 6 months or every quarter, however it's all set up. The discount, the disadvantage, the big disadvantage of this is that the yield curve can be skewed for CDs, and typically they're lower than bonds or some other instruments, probably equivalent close to treasuries, the risk-free rate. But the yield curve can be skewed. I've seen a lot of credit unions or banks will have specials, an 8-month CD, and they're paying like a quarter of an interest rate higher than what normally would be there. And that's because in their mind, they need to have a little bit extra capital. They're willing to pay for it for that particular time frame. The big disadvantage for CDs is that if you need the capital, you can't sell the CD necessarily on the secondary market. You go hat in hand to the bank or credit union and you say, I want my money, and they say, fine, but you're going to pay a penalty because you withdrew early. And I don't know what those penalties are because I don't do CDs, but that's one of the issues with CDs. They are not liquid, and a lot of times the institution will automatically roll it over. So if you're not awake and the CD you have is at 4.5% and the renewal rate's at 3.5%, and you didn't pay any attention, you get a new CD at 3.5%. So that's one of the disadvantages to that. So who's bored out of their skull right now? Oh, we're all asleep. Okay. So what are the tax consequences of owning bonds? Oh, yes, taxes. So corporate bond interest is taxed at ordinary income. So those are best put in your retirement account because you will not pay any taxes on the interest that you receive. You only pay taxes when you take the money out of your retirement account. So that can be an advantage. You can have capital gains or losses. You can actually, again, you can buy and sell the bonds, and you can sell a bond and have a capital gain, or you could sell a bond and have a capital loss. You may need the capital, you need the cash, and so that's why you would sell at a loss, or you're looking to do tax harvesting or something like that. ETFs and mutual funds. So when you hold an ETF or a mutual fund, they're constantly buying and selling bonds, and one of the disadvantages of holding those bonds and those instruments is that you don't know what the capital gains situations are going to be or what the distributions are going to be until they happen. And that can have some major consequences, especially a lot of mutual funds especially will do distributions at the end of the year, and you've kind of got your tax situation all set up, you're ready to go, and then all of a sudden, lucky you got $9,000 in capital gains distributions, and of course you withheld no money for the taxes, and now your perfect calculations are not so perfect. But first world problems, right? So why bonds can be an important part of your portfolio. So why bonds? Bonds are boring. Bonds are boring. right? Studies show, and this is anecdotal, but there are a lot of books out there that will go through this. So studies show that if you own just stock, you'll do pretty well. If you own just bonds, you won't do nearly as well. They're not the same sort of instruments. But if you own a combination of stocks and bonds, and I don't know exactly what the perfect mix is with it, and it would vary over time, that you will outperform either one individually. And the reason is the volatility of the bond portfolio will be much lower typically than some of the worst years in the stock market. So you can see corrections in the stock market that are not unusual, 10, 15, 20%. Typically that doesn't happen in the bond market because interest rates don't move that fast. And you get that coupon payment, so the interest payment kind of puts a floor on how low the bonds will go, provided that they're still credit worthy and can make the coupon payments and the interest payments. So having that perfect mix is really helpful. You know, back in the day it was 60-40, 60% stocks, 40% bonds. You know, you took your age minus 100 and that would be the mix for stocks and bonds. I think that thought process is changing, and I do think it's more 70-30. They like the ideas that you would have more equities and less bonds. But I really think it's an important part of your portfolio to reduce volatility and to just have your portfolio do better in the long term. Investment horizon also plays a factor. Again, you know, Fidelity says I'm going to die when I'm 93, so my investment horizon is what it is. Your investment horizon may be different, so you just have to kind of say how you want to have that work out for you. Okay. So I know I haven't touched really much on munis, and we can talk about that if there's any questions. I can address those. I don't think I left anything out. So I think the takeaways like I had here are the inverse rules of bonds and price and yield. So again, prices go up, yields go down, prices go down, yields go up. The credit worthiness, the rating of bonds, that's important. So investment grade goes from AAA to BB, and then buying bonds, know the risks. So again, how bonds can affect your overall portfolio, God, this is what I thought. So capitalization, capital preservation, and again, and an income stream is also important, you know. And for me personally, and I think for a lot of people in this room, capital preservation is important. Equities are great, they go up until they don't. And a lot of people, 10 or 50% reduction in their portfolio can be a little scary. Bonds generally don't do that. So when you're trying to preserve capital, because they're usually less risky than equities, and having that mix really helps to have your capital preserved. In other words, you got your nest egg, you don't want to lose it all. And they also provide a nice guaranteed income stream, well, guaranteed air quote income stream. So I think that there's a really important role for bonds to be in your portfolio. Another thing that I've talked to a lot of people, well, some of the people here, I know a lot of people say, so how's your portfolio doing, Bob? And they go, oh, my guy handles it. They send me a check every quarter, every month, I'm happy. I go, do you know where you're invested? And they go, they send me a check every month, I'm happy. And that's fine, but I really think that it's worth your time, even if it's 5 minutes or 10 minutes every quarter, to look and see what you own and see what kind of portfolio you have in your bond portfolio as well as your equity portfolio. To me, it just makes prudent sense to do that. I'm not saying that you need to go rush out and buy the bond book and read it and memorize the cover to cover and, you know, read a bunch of stuff on stock market. But I think just knowing what you have, to me, makes a lot of sense. And so that's my little thing. Know what you have. I think it's really important. And so thank you for coming and joining me for this thing, and then we'll go ahead and take questions.
Michael,
Yep.
you said that you could do limit orders, but you said only one day. Is it always only one day? I wasn't aware you could do limit orders.
So the brokerage company that I use will, for when I buy a bond, I have two choices. I can do what they call a fill or kill, which means they'll either fill it immediately or they're day orders. And I think that has to do with how thinly the bonds are traded. The difference might be treasuries, but I'm still pretty sure they're day traded.
to know what I bonds are and how they differ from the kind of
Oh,
bonds you were talking about?
So I bonds are similar to a savings bond. They pay a pretty high interest rate. I think and I'm not sure, you can buy them through Treasury Direct. Their interest rate is usually, I think, a 1 whole basis point higher than the other bonds that you can have. The only issue is that you can only buy $5,000. Or 10, okay, thank you, 10. So if you wanted to buy I bonds, great, $10,000, that's your limit, and then you're done. I don't know if you can buy every year or you can hold only 10,000. So they're very limited. They're good for, like, if you have little kids, you want them to be able to get some money and it's super safe because they're, backed by the government, but they're limited in the amount you can have.
Hi, can you talk a little bit about your views on inverse yield curves and the increasing level of government debt with most countries?
A little bit on the inverse yield curve, sure. So what's happened over the past, I think right around I think maybe starting in 2019, but I'm not exactly sure. So like I said before, basically short-term rates will be lower relative to longer-term rates. What happens sometimes is you get what they call an inverse yield curve, where, like back in probably 18 months ago, 2-year treasuries were paying higher than 10-year treasuries. And that's counterintuitive. Why would that be? And that can be a harbinger of the fact that the economy may be slowing down. It's just odd. A lot of times when that happens, that is a predictor of a recession coming. Take advantage. I mean, that's what I was doing. 2-year treasuries at 5. I was buying those, absolutely. But again, I think you have to look at your horizon. They're not going to last forever. That was great when it happened, and then I think the yield curve is starting to flatten out. In 30 years are paying, I don't look at 30s, but I know 10s are about 4 1/4, 4 1/3, and 5s are about 3.8 right now. Did that answer your question?
Yeah, and the related issue is the increased level of government debt in most countries.
Oh, sure. That's a tough one.
That's a question for Jerome Powell.
Yeah. Thank you. Well, we'll have Chairman Powell answer that, but I think the short-term answer is that we're just going to have to wait and see, but I think you're going to see some inflation because of that. So.
Michael, honey.
Hey.
I want to know how Fidelity knows you're going to live till 93.
Because when they have their handy-dandy little retirement program, and they say, this is my assets, these are my income, this is my debt, and all that stuff. The table stops at 93. I guess that's when, let your kids know you're only living at 93, because that's when that table stops, and then they tell me how much money I have unless I start spending a whole lot more. So that's how I know. And I got a few years, so I'm cool with that.
Like the universe ends when you reach the end of the Mayan calendar.
Pardon?
Like the universe ends when you reach the end of the Mayan calendar.
Exactly.
But, I know the difference between small cap stocks, where you can invest in many of them, and if you just get one home run, then you're set for life. And there are what they call penny stocks, which are the same thing to a huge multiplier.
Right.
What are the equivalents in the bond market?
So the equivalent in the bond market would be bonds that are in default. So there are bonds where the interest or the coupon payment is not being made, and the principal is not being made, and the company is basically, they haven't filed bankruptcy. They're still a company, but they don't have the cash flow to be able to pay their debt. They might be able to at some time, and typically you can buy those bonds at a pretty significant discount, maybe 50%. You're probably going to do like the same thing. You're going to buy a lot of bonds before you hit the home run. But that would be the equivalent of doing that. Big risk, big reward. Again, that's for the pros. And there are companies out there who do invest in that sort of thing. They think they're smart and they can figure it out. And of course, sometimes they do.
You briefly mentioned inflation.
Yes.
And that's not factored into any of this. If I get a 10% yield, I'm gonna get 10% more. But it may not be worth nearly as much. My Volkswagen that I could buy today, but I'm gonna put the money in because I wanna buy a Maserati, might only buy a Volkswagen when it comes to insurance.
Exactly. So yeah, so there's always going to be the erosion, the purchasing power of the dollars as you go by. I don't know that that's actually included in the calculation of pricing of bonds because I don't. What rate do you use? I mean, it's kind of hard. There is a discount rate included in that calculation, so that could be the imputed inflation rate. And that's something that you just have to, again, when you're looking at your maturity level, that would be a factor. Inflation would definitely be a factor in that. So you should be rewarded for that. Inflation would be part of the risk that you'd be looking at. Yeah, absolutely. Yeah.
Can you explain a little bit more about the dividend reinvestment or the interest reinvestment?
Yeah, sure. So when you do the pricing of the bond, the idea is that you're going to take that coupon and basically compound it, because again the par value of the bond is 1,000. The amount that you get at the end is 1,000. So what are you doing with the coupon? And then the concept is you put it in an account of some interest-bearing account, and the idea is can you get at least the interest rate when you bought the bond or the coupon on a new issue? Then you would be compounding your investment at 5%. But a lot of people, well, what do you do with the coupon money? Do you spend it? Yeah, spend it. Exactly, that's the right answer. So that's the idea. That's where the pricing of the bond goes into that factor. But again, these bonds are paying you cash. You can't reinvest in the bond because that would be 1/50th or something like that. But you can just put the money in and then get ready to buy some more bonds. Have it in your money market account, or there's always Lucky Lady in the 4th at Belmont. Yes.
You want to say anything about international bonds and foreign countries paying higher interest rates?
So I've noticed that, and there's a lot of risk involved in that I'm not an expert at, but you can do that. The sovereignty bonds do show up on the Fidelity list, but then you have, like I say, you're getting rewarded for higher risk. I mean, you can buy Argentinian bonds, you can buy New Zealand bonds, you can buy Aussie bonds, you can buy Euro bonds, I think. There's a couple of risks like that. We have the inflation risk would be one of them, and then the transaction of the currency would be another. So when you buy those, you have to look at, okay, what is the value of the currency that you're going to invest in, and what is going to be the conversion rate when you get your coupons and when the bond matures. If you want to do that, I would recommend either studying a lot more or using funds to do that, because it's complicated. It's complicated. I think we have another question over here.
Where do bonds stand in the hierarchy of who gets paid in the event of bankruptcy?
So typically bonds, not all bonds are created equal. So there will be creditors of the company, and the bondholders are creditors. So when a company goes bankrupt, I'm not a bankruptcy judge, but the bondholders will get paid before the stockholders. So if you're a shareholder of a company and it goes bankrupt, you are last on the list. So if they have like accounts payable that need to be paid, they may have pension fund requirements and all that stuff. Eventually they'll get to the bondholders, and then they'll figure out what's left, and then the bondholders will be paid. But they're ahead of stockholders. And I think they would also be ahead of preferred stockholders. But each company would be a little bit different. So.
Can a company pull a bond at any time, like say the interest rates that they originally did was like 7%, now the interest rate is 2%. They're like, I don't want to be 7%.
Yes, absolutely. So think of bonds in a way they're a loan, an IOU, and like you have a mortgage and you bought your house. Interest rates are around 5%, 6%, whatever it was. And then a year and a half later, they're down at 3.5%. What do? You refi, absolutely. So some bonds are what they call callable. A lot of bonds are callable. And in that offering, they tell you all about the callable dates, and there are specific dates when they can call a bond. I actually bought a bond from Bank of America, and it got called because exactly what happened. It was a 5.25% coupon, and they can refi it for 4.8 or something like that. Now, companies do have a cost of issuing the bonds, so they have to look at the balance there. But you have bonds that you can buy, which I do this sometimes, called make-whole bonds. And so they are callable, but the company has to make you whole for calling the bond early. Basically, those bonds become non-callable. Doesn't make any financial sense for the company to call the bonds. They typically pay a little bit less in interest because you have that guarantee of getting your coupon payments through the end of maturity. But yeah, and some bonds, they might not be callable for the first 2 or 3 years, and then they may have every year after that, every 6 months, but they are callable sometimes. Treasuries are not callable. Yo.
Hi, Michael.
Hi.
You want to speak a little bit about private capital and the role of third firms, about like Blue Owl Capital that are trying to finance?
Yeah, so business development companies are kind of what you're calling BCDs. I've actually bought bonds that they have issued to fund those activities. I'm not that familiar with BCDs, but basically they're bank-like companies, business development corporations, that will find a niche where they're offering loans basically to kind of smallish to mid-sized companies that don't have access to capital. Otherwise, they're not quite credit-worthy enough, or maybe the volume is enough to make it interesting for them to go to Wells Fargo, JP Morgan, or any of the money center banks to do that. And they do pay a coupon a little bit higher. They are still investment grade, and I've actually done Blue Owl, so they're out there. And they're interesting businesses to buy equities in too. In fact, Morgan Stanley has a company, a VCD, that I just recently invested in, just a little bit. It is high risk, but they're paying about 11.5% on their dividends. So.
Are you going to say anything about TIPS, Treasury and inflation protected?
They're kind of a niche. Inflation is, even now it's only 3%. I don't know that you really need to hedge on that. But what he's talking about is Treasury and their inflation protected bonds, where there's a feature that I think they adjust depending on what the interest rate. So they're a bond that has a coupon issued through the treasuries, but they will change the interest rate based on inflation. So they may pay 4%, but if inflation gets to 5%, then they'll go ahead and make up the difference. I'm not sure what the maturities are on those. Are they, do you know, or are they typically like 5-10 years, something like that? For the TIPS? Okay, don't know. Okay. Any other questions? All right. Well, thank you, folks, very, very much. It's been a pleasure. And we'll see you later.
Thanks, Michael.
Oh.